least edit it. And we'll get going. So welcome. So this is a slightly unusual recording, A, because it's live, which I love to do, and B, because I've already recorded the podcast this morning. I was telling some people I had a head of dynamic asset allocation for one of the Australian superannuation funds on the podcast at 4 a.m. So I guess I could say I know what works and what doesn't in terms of these discussion topics. So I thought that I'd take advantage of this group we have here to dig into some questions that I have that I'm sure you are well equipped to answer. And the reason why I love these type of events is the camera's on me, not on you. So you can say what you like, and it may or may not be for attribution, but it's because we have such a range of talent and skills in the room. Yeah, starting with, we've got hedge funds, asset allocation, private equity, asset allocation, everything, hedge funds, real estate, broker dealer and wealth management, private credit, the foundation side, asset allocation, and more on the asset allocation side. So I would love to have, it's great that you've had a chance to get to know each other. And there are just questions I will throw out. We do cycle through the same 5 topics every time, but I'd love to have your input. And I have this little dinky mic, which I'll poke at. I was going to point in your direction, and we'll try to capture what we can. But why do I do these? We as wealth managers always want to have a demand for this kind of discussion. I think more so now than ever when we start breaching these norms that we know. And I think the important thing with these discussions is it's great to have, very fulfilling, but we often don't tie it together to the implementation side. So what for the portfolio? So that's as much as possible what we try to do is translate these macro factors into asset allocation decisions. And there may be no decision, but there may equally be something to think about. So with no further ado, I'll kick off and move us on, and hopefully the slides will appear, as they have. So we talk about 5 topics every week: inflation, interest rates, geopolitics, equity markets, and other asset classes. I kind of think of it like the 5 fingers of the hand. If you are touching all of those topics with a client in a meeting, you tend to have covered most of what you need to think about. And in this particular week, a couple of things have come up. We've obviously had a new normal around inflation, kind of is it 3% now? Is it 2%? We need to think about how do we maintain portfolio resilience. And I'd love to ask you that. That's one of the questions. If we're dealing with an overall higher baseline when it comes to inflation, or kind of a resting heartbeat, I've heard some people speak about. And we know that rates are easing just yesterday. But risk seems to have fallen if you look at spreads and where bonds are trading. But is this really the case, or has all the risk just been transferred to private credit, which is where there's this kind of no systemic risk according to the powers that be, but the cockroaches, 1 or 2 or 4 popping up, and therefore what does that mean? And I think another really interesting thing will show is how some of the asset managers have been reacted and reflected in their share prices. The asset managers who are purveyors of private asset classes. That's quite interesting. Corporates are staying nimble. Usually that means they're cutting costs, cutting staff, and that's getting rewarded, but it's not great for the economy. And then we'll talk a little bit about that tangled web of AI and interactions and overlap, because if you guys can make sense of it, well, that will definitely further me along my learning curve, because I think the tangled web of AI remains very difficult to parse. So this is inflation. I talked about this a few times. This chart has been coming up, but I'd say it's definitely not fully subdued in terms of the US. We're looking at about a 3% number. 2% was the target. But there's a distinct lack of concern, it seems, around this inflation rate. On the one hand, oil is coming down, or has been down. So that's been some kind of, I suppose, solace at the pump. But food prices, depending on who you ask, and it's difficult to get real data, definitely are pinching the lower end consumer. We know about the pressures on them. So I suppose the question is, whether this is now just the new normal. It seems that expectations are also down. But I'd love to put it back to you. If higher inflation is here to stay, and I mean higher at this level, how does that affect how we allocate? Because on the one hand, rates are coming down, inflation's going up, so the real return is lower, and cash won't be as much of a natural place to stash dry powder. And what does that mean for, say, for real estate, for real assets? Do they look relatively attractive or not now with lower rates? Do they provide an inflation hedge? And one question I have on real estate is there the ability to push through an inflation adjustment in the same way there used to be? We used to think it was kind of automatic that you get an inflation adjustment on leases. And how does this affect risk appetite? So I'll throw it open. If anyone would like to be first to answer on the side of where we are in inflation, are we higher? And does that affect what we do?
I remember reading an economic research a few years ago, and it basically said after such a high inflation as we have, it usually takes way longer than people think to bring it back to 2% historically. So this may just be a normal pattern, that it's just we don't go back to 2% straight. There are some embedded dependencies that make it take longer. I mean, it's not very deep, but that was an empirical research looking at all these periods and said usually takes longer than people anticipate.
And I'm from the, I think that this joke that I've heard you see, it works in practice, but does it work in theory? In practice, based on sort of like as a consumer, I have watched consumer goods, in the mid to high end, almost double over the last, clothing, restaurants, travel, etc. I do not for a second think those prices are coming back down anytime soon. Right. So I think that the inflation will creep from into the middle and upper middle and beyond classes and stay there for quite some time.
Exactly. And then just thinking about the using cash, if this now places, the erodes the real return on cash, where will that just, just really kickstart the hunger for yield, the risk into risk assets? We did see cash being respectable enough for a while. Any thoughts on that? I thought there was an answer coming. Go ahead, yes.
I'm going to give a very specific example. Cash. We've been holding a lot of cash for the last year and a half.
It's a Chicago public fund.
Yeah. So that's it's very specific to us, and it's been fine, right? We made that strategic decision to not invest because we have to utilize that money for fund. However, now those high cash allocation are creating a drag on our portfolio, and it's something that's becoming more concerning. So we are looking into options to just not final decisions, but how can we utilize the cash differently? Which kind of strategies we can? It's almost $1 billion. That's yes, exactly. Yeah. It wasn't a concern. Now it's more of a concern. So looking into where can we, which is a difficult question, right? Where can we allocate the cash, knowing that it's a short-term allocation that we'll be making and rolling it over. And just to continue quickly on real estate, we have not lost confidence in real estate. I think now there is more looking into the manager skills and what they are doing and which kind of niche strategies they are in, because they differ, right? It depends on the sector you're in and what you're doing. Also, how are you implementing those strategies? And just the last, in terms of infrastructure, inflation, I think looking to increase our infrastructure allocation just to kind of balance out the inflation side.
And that's really helpful. Thank you. And I think it's interesting on infrastructure, given where energy prices are and the data center pressure that's putting on energy prices, and whether that's going to flow through into infrastructure returns or whether they'll all be fighting over the same energy allocation. So what's this going to do to infrastructure business models, I think is interesting. Just to finish on real estate, that point about inflation hedging.
I was going to say, I think a lot of institutional investors saw that real estate didn't quite provide the inflation hedge that they thought that it would as we went through this inflationary period. Why exactly that is, I'm not fully sure, but definitely I think there's been a little bit of a shift there in how institutional investors are thinking about real estate as an inflation hedge. And to the point of the lady talking before me, I think there are different asset classes that might be able to provide more of an inflation hedge than others. For example, a hotel obviously is priced daily, so you can get you can reset pricing right away and be able to absorb inflation, whereas like an office, which is obviously very out of favor, but offices, leases are longer, and if they don't have CPI bumps built in, then you're not able to reset. A lot of things are structured triple net, so all the expenses go toward the bottom line, which I think is, helpful in terms of managing expenses. But I would say that from an institutional investor perspective, real assets has been more responsive to inflation and has provided more of an inflation hedge during the last period. And so I could see that infrastructure, possibly oil and gas, depending on restrictions, being more interesting as investors think about how to protect their portfolios from inflation.
It's really interesting. I think it's a very dynamic thing. And I think that's what we're looking at. And then just to build on Nadia's point about the where else do you go if you don't stick it in a money market fund. Well, I think the point is it really bonds, traditional fixed income with the tight spreads today does not look particularly attractive. It seems like there is a sanguine approach to risk and fixed income. And I think the question is, if these are usually the ones that the part of the market that is most concerned, most worrying, that's the part that had the tantrum in the past and tipped many things into reverse, say, in terms of some of the tariffs. But why is there no attention to some of the potential risk in fixed income, or has it simply gone away? Is it wishful thinking? Has it gone away? We saw the Fed talked about fog and navigating the fog, and not necessarily knowing what to make of the data when it came to employment. That didn't, and also not, I think my sense today is that the chairman is very much still in control of his narrative and of what he's doing, that they're not succumbing to political pressure. It was one cut, probably was in given where employment is and where employment could be going, was probably merited. But it certainly was interesting to see the market react negatively when they looked like they were not necessarily getting another cut in December. So the just moving on to where is the problem, and this is equity market, but I would go back to just has the risk moved to private credit? I left out the cockroach picture here. I thought you could all just do without a picture of a cockroach. But there, I'd love to hear whether it's going to private credit. And we did have some these, actually see where we have the private credit picture. The credit market's humming, and that has Wall Street on edge. It seems that discussion of cockroaches, of shoddy due diligence, and of missed complex financials is now abound. And if we look at where the Blackstones, the Ares, KKRs are trading, they've had a shockingly bad year, given what markets have done. So are investors actually voting with their feet? Are they seeing the writing on the wall? And maybe sort of seeing that there's trouble ahead?
Private credit. And when we think about private credit, from a simplistic perspective, one thinks about corporate direct lending, private loans, right? And in that space, there has been a strong inflow of capital, as well as a lot of new formation of private credit funds or direct lending funds over the last decade. It's really private credit for a very long time provided a premium over more liquid, broadly syndicated loans, high yield, et cetera. And so from a relative value perspective, investors really like the asset class. Well, that was then, and this is now. So what has happened over the last 2 to 3 years in the higher interest rate environment, it really continued to impact the inflows into private credit, because as rates increased and private credit or private direct lending uses floating rate instruments, private credit became extremely interesting from a relative value perspective. However, when there was an inflow of capital, all of a sudden there was a real rush to find deals, and a lot of deals were being done in the private equity market. So that number one, that is a very risky situation where you have a lot of capital chasing very few deals. People are more apt to take on more risk. And in addition to that, investors liked the cash flow distributions from the direct lending space. But what we've seen is that there's been a trend towards PIK, or non-cash interest in the direct lending space. So the asset class isn't even providing those cash distributions like it used to. So now we have slightly declining rates. We have direct lending portfolios with a fair amount of risk and a fair amount of PIK, loosened covenants, a lot of competition for fewer deals. Although I know private equities, M&A is bouncing back a bit now. Which seems a little bit like a recipe for disaster. So I think it is fair to look at direct lending, corporate direct lending, as an increasingly risky sub-asset class of private credit. More sophisticated investors saw this coming and have been trying to diversify their private credit portfolios into areas such as asset-backed lending, opportunistic special situations, capital solutions. So especially finance, which is kind of part of that asset-based world. And as a result, more sophisticated, I mean, I don't want to say that, but many institutional investors have been actively diversifying their private credit portfolios, which will be a mitigant for that risk. For example, capital solutions provide solutions for those direct loans that may, have issues in the current environment. So that's good. The other thing that we see in private credit that is we have our eyes open to is the very aggressive move of the large private credit GPs into the wealth channel, right?
Yes.
And and honestly, that's an entirely different conversation. But what we're seeing is a aggressive creation of product for the wealth channel that provides semi-liquid or advertises itself as semi-liquid. But as we all know, when things go bad, loans are not semi-liquid. Sorry about that.
And I
Go ahead. Yes.
I want to piggyback on that because I have two things to point to is that because they call it private credit, a lot of people were like, oh, that's like private equity. And there's a lot of things that have been sold on less liquid terms that really could be in much more liquid structures throughout. And people have bought it. And there's going to come a time when they're going to need liquidity and they're not going to be able to. But there's another issue that has been bubbling up and has been, if you read various Fed articles and things like that for at least the last 6 to 8 months, and that is that the subject of NDFIs, non-depository financial institutions, providing leverage to hedge funds and others in the private credit space. And even banks now are loaning. And a lot of these people in this rush to grab, whether it's in the wealth channel or others that are pouring money into private credit, they're leveraging their portfolios. And that, as we know, let's talk about 2008, is a disaster waiting to happen. So there's a lot of great opportunities in credit and private credit, specialty finance, whether it's asset-backed, aircraft parts, various things. But it's about understanding who's providing it, the structures. A lot of them are very obtuse. Understanding where you're getting that opportunity, what you're paying for it, and what the backstops are.
And it's a fascinating insight. Thank you. I suppose it is a little troubling when we think of that. But I also thought this the share price reaction is quite telling because mainstream financials are doing okay. They've been taking advantage of the trading market, of the M&A market. They've actually done quite well with their diversification and they're in rude health. And then to see this backfire on some of the diversified financials has been interesting. Okay, so
one last thing that I wanted to add that I think is really important and is a driver of that share price is that direct lending has been become a very commoditized business. One could view direct lending as more of a beta play, and there is a race to the bottom on fees. And I think that is one thing that is really being shown in these stock prices of these Blue Owls, Aries, etc.
And maybe it's looking to the future because their actual numbers were they surpassed expectations. Yeah. They were still buoyant. Was that your point as well?
Hardly, but some of them do a lot more private equity, right? And there have been a lack of exits. So they all. Mm-hmm. Yeah, that may be a reason also why the stock prices haven't performed so well. So I read that article too and thought, yeah, makes sense. But then they make a lot more money in private equity, so maybe there's something else going on.
And to provide a data point on the fees, which is spectacular, actually, the Golub Capitals, the areas of the world 10 years ago were charging 2 and 20 for direct lending exposure. Today, they and others are giving direct lending away at 10, 30, 50 basis points flat.
And that is exactly why it's a quote about the first brands said that we were not being paid to do due diligence, essentially, which is alarming when you think that even that, obviously that's a loss leader in that case, and there simply isn't a spread to do due diligence in the right way, which is so we've really got, so none of us here is drinking the Kool-Aid, it seems, on private credit, which is, well, for private assets, which is great to see. Well, let's go into equity markets, because there's another, I think, a set of jargon that we need to decipher. And back to equity markets, clearly we know the headlines. We were approaching 7,000 on the S&P. We had something like 19 records the last time I looked, and now it's probably well over 20 records consecutively. We've seen NVIDIA become the first $5 trillion company, which surpasses the entire market cap of the UK, adding Singapore and another on for good measure. So I think the question is, this has been just a non-stop diet of pain for active managers, because this chart shows the comparison between the equal weight and the S&P market cap weighted, and we know that that's been a divergent path for some time, but it's going to just continue and get even more painful. So I suppose that the question is, and what I'm trying to wrestle with is, how do you tackle an equity market where you have a single stock that is the entire market cap of one of the largest equity markets? I mean, the US is around 70 trillion, so clearly the UK is well below that. How do you allocate? If you had a portfolio with a 20% holding, say a concentrated portfolio, you would expect a lot more volatility. So do we just have to expect more volatility? Do you nonetheless pursue an equal weight? I'd love to hear insights as to whether we need to think differently about equity market, and what is the end game for NVIDIA. I've a chart here just showing how interconnected NVIDIA is. It really, and this is even not including PayPal and some of the other stocks that just got a boost from even mentioning a connection with NVIDIA in their recent press release. So clearly all roads lead to NVIDIA, and that's this $5 trillion market cap. But what's the end game? I'll go back to the equity slides. We'll come back to the bubble question soon. So how do we navigate increased concentration, and what does this mean for asset allocation? Any from our asset allocators? Uwe?
Well, this is a problem, obviously. So what my solution was is, okay, I believe in the story, but, well, it's scary. So one can allocate to other markets that are also in technology and can benefit from this, like China, Israel, or so, at way lower prices and better diversified. So the hope is, well, there's maybe more upside and you get a little bit of diversification, although it's all going to be highly correlated. But it's not a perfect solution, but a mitigating solution thing with higher upside and lower downside.
Yeah.
Other technology markets, just outside of the US.
Outside the US, exactly, yeah. But then when we have Larry Fink suggesting we should overweight the US, and we have this lower money market rates and people looking for cash, it seems that the technical pressure may remain, and it makes that divergence. Anyone else on the asset allocation? Do you think we need to think differently?
And it's probably not thinking differently. I think it's just a difficult question to answer, because there's just too much unknown, and it's been a continuum in a way. It's been going on for a long time, and going back a little bit to the basic of keeping diversification. I think keeping the focus on diversification and trying to trim on the margin. Yeah. I mean, on our we have our large cap is indexed. So trimming on the margin there, but really keeping that with diversified portfolio, because exactly that end point is, even talking to our managers, everyone is, we still believe in the US, and then the non-US, we believe in the non-US. It's the ball is kind of everywhere, and maintaining our course, that's what we have done, because we just can't answer that question.
Go ahead.
Yeah, I have a question. So, like, how do you evaluate alpha since the beta is already very high? Like, how can investors still find? I mean, I'm just thinking about the question, but it's just like really hard if you think about where's the next, alpha.
Well, exactly. I mean, that is the great question. And I think when I mentioned the pain of active managers, what they would say is that, well, we protect on the downside, we will give you that sort of solid lower volatility profile of returns. They will talk about the 490 that are lagging and that have shown some interesting upside. We've seen some stocks that have been well beaten down, whether it's the drug stocks or maybe UPS or a stock that announces a big employee cut and they get a major pop because they've been playing catch up. So I suppose there's active to that. I really think it's a very challenging market for alpha, obviously today, especially in large cap, US large cap. But I suppose if you're committed to diversification, which I think you should be, and every strategist would say you should be, you can find the alpha, whether it's in emerging markets in Chile or in Europe. The issue is how much is that an ever shrinking part of your portfolio? And just like we used to say about alternatives, well, what's the point? If it's only 2 or 3%, it's taking all my time. Why am I bothering with this 2 or 3% when, what difference is it going to?
So is alpha, I mean, I know this isn't the purest definition of alpha, but is alpha really moved in this environment from active management to portfolio construction? Is that really the only way to get true alpha in a portfolio?
At the overall portfolio
Yes.
size, that's a great point. Yes, and I think, getting into alternatives, real estate, real assets, getting your US overweight in a more diversified way, because there are still exceptional excess returns in some of those areas.
So you could take a portfolio beta and through that construction create that. That's really going to be the only source of alpha that you can get.
Alpha is also very small, I think, how it's generally measured, because managers choose a benchmark. And then even if they have alpha, okay, but it's like, okay, you're 20 or 30 basis points above your benchmark, but the choice of the benchmark is like 20%, So yeah, alpha exists, but what you said, it's more like where you go. That makes a lot more money. And I would love a manager that says, okay, the whole world is my playing field, and I don't have a fixed benchmark. My benchmark is whatever the 10 biggest market that ever performs best. That's my benchmark. So that they are much more active, because a little bit here and there overweight, you have an ACV and you're 1% over in China, whatever, it doesn't help you. It's just a few basis points.
Yeah, it's very interesting. And I think not so long ago, we were talking about sustainable equity as being the kind of backdoor sort of, I suppose, the Hail Mary pass or whatever you call for alpha, in that if you wanted to have a sustainable portfolio, focus maybe on positive growth, you would have to be active. You would have to exclude, say, the energy stocks. And that was really giving a last gasp to alpha strategies. So I think with this melt up that we're currently seeing and these dominant stocks like NVIDIA, it is a good question. And I think we need to think about, do you even have a distant risk reward profile for those two, the two sectors, your US large cap tech and everything else, which gets out there. So just in terms of what we're seeing, some of the cross currents again around employment, and this gets to this AI bubble question. So we have NVIDIA, despite being 5 trillion, has actually underperformed others as chip stocks. So that's been interesting to see, just that NVIDIA effect, how all roads lead to there, but they seem to have a contagion effect. And an interesting chart from Ritholtz, which showed this gap of expectations versus reality, whereas tech stocks still have the market cap share continues to rise. Their net income share has not risen in sync. So even though we say the fundamentals are there with tech stocks, they're still well ahead of where their fundamentals would suggest. And that's the froth, and that's the excitement, and that's the web. And I think part of this problem, it seems to be, Catherine mentioned this kind of newfangled structures and opacity that we weren't necessarily getting insight into private credit. And that certainly has been a factor since 2008. I would suggest the same kind of foreign language is now being woven in AI, and that many of these acronyms, the relationships, the power, does that have meaning? Do these numbers have meaning for the average investor? And when we see these large interconnected relationships, how would this potentially unfold? Were we to do a scenario analysis? And what I described as the sting in the tail was this headline here about Amazon. Clearly, the rates, they're starting to see job cuts. There was a fascinating insight in LinkedIn. The problem with AI is we don't know what's real or what's not, or whether there's any data behind some assertion on LinkedIn. It was that these job cuts were not happening because AI was working. They were happening because AI was not yet working. That they were basically cutting jobs in order to take cash and put it into data center spend. So that in a way, there was no productivity gain that was the basis for these job cuts, but they needed to take from one side to pay for the other. And there's also a suggestion that there was massive excess capacity not being used. And I don't know whether there are any insights on the tech side of that, but whether if we're building excess capacity that's not being used and it's not going to necessarily last forever because it does have a shorter shelf life, what is this investment for? And will we have a new form of stranded assets on the AI side, just like we've been talking about it for years on the oil and gas side? So does anyone have the laser insight into whether this is a bubble or will we? It seems like there are two camps emerging among commentators right now. Some that would say, "Don't worry about it; it's only in its infancy." Others that would raise the same flags.
I'd be curious, Kelly, in the hedge fund space, how are hedge funds playing,
I think that,
or not?
I think that in terms of investing or in terms of using, right?
Using.
We'll start, we'll start with investing,
in-
but using is also interesting.
In investing, there are, the tech funds have their analysis. There's not a J curve when it comes to investing in tech, right? It's got its own curve. Actually, they would say everything's fine. It is as it is. There's a lot of different layers, and these companies are on different layers. It's not really a web, it's multiple layers, and things have to happen and progress and kind of penetrate the layers. I'm not really good at explaining it. And so that will take time. And actually, in terms of development, it's happening faster than things would expect, but the results won't show yet. So, but there's going to be losers, right? There's going to be companies that put money into it and things don't happen. But there's a lot of things that support it, right? Data centers, power plants, nuclear. I mean, we put 3 Mile Island back online for this, right? I mean, who would have thought? Older people would never have thought this. Younger people probably don't even know really, again, what happened. And they're modularizing nuclear reactors, right? And putting them everywhere. So there's a lot that will, not NVIDIA itself, but there will be a lot of growth. So maybe Amazon employees or other employees that are getting laid off right now will have to find other jobs elsewhere, but there will be jobs that grow from it in different places. We are seeing hedge funds explore the use of AI in terms of data and intelligence gathering. We are actually, one of our former employees who was a master's PhD student at Northwestern, worked for us about 12 years ago, moved to Arizona for his wife, ended up working for Northern Trust. And when they bought the Citadel operations group, that became part of his portfolio. So he learned all of that part and ended up doing some work for Renaissance. He has a team venture funded and is building some AI software. He had built, when we left the bank, we had Excel spreadsheets for our operations and our portfolio monitoring. He had kind of given us macros and stuff to run it. He is now building for a design partner, right? So he is giving us AI for that. He's doing some stuff for hedge funds. They're testing it for different pieces. I will tell you now, it's not going to change.
Not going to replace.
It's not going to replace me as a lawyer
Yeah.
yet. We tried that. But things are developing.
Yeah.
And so people are experimenting. It's going to take time, and AI has to learn. So it's early on. Is it going to be the tech bubble? I don't think so.
Yeah.
Are things going to fail? Sure.
Yeah. Well, the interesting part, and maybe I'll just bring this to a close in a minute here, the entire podcast, is that I think the fact that we're having this debate, clearly there is not, general intelligence cannot tell us this. We don't know. So there's actually quite a bit of inefficiency still in the market.
Yes.
I heard it. I can send you the link, the podcast I listened to this morning. about, why would, if stocks are falling 10, 20%, 30% a day, in some cases, well, clearly that market's not efficient. Because if we knew it all and if all the information was out there, we wouldn't be having these kind of drops. So the fact that AI cannot tell us the answer as to whether there's a bubble in AI, I think is really the whole point. Is that we actually are, there's a lot that we don't know. There's a huge amount of complexity, whether it's in private credit or AI. And that, in fact, makes our jobs quite interesting because there will always be something to interpret. But it also means that the search for alpha will continue because there will be a belief that getting that edge, getting that forensic due diligence on the next blow up in private credit and going short, or on the AI, the winners and losers, I think that would probably be the best argument we have for alpha. That just so much we don't know. And I think we can probably skip we've kind of talked about the web of complexity. And I suppose the just finishing up in terms of the international point is, I think what we're seeing is that there's a tremendous amount of obviously opportunities still outside the US. China has obviously been the story of the last few weeks. China, we know, has a lot riding, given where its stock market is, a lot riding on trade negotiations, just like the US. Clearly, that's the one thing that Bitcoin doesn't like, and markets really don't like, is an explosion in US-China tensions. So let's see where that will end up. But that was really all I had for today. I think we've cycled through a lot of different topics. I'm trying to keep you all on time. If anyone has anything else to throw in that they'd like to discuss, but I think it was a great deep dive into private credit, hedge funds, asset allocation, and what a public fund is thinking, as well as real estate. So thank you so much for coming here and sharing your views.
Thank you.
Thank you.
Thank you. Very interesting.
Is that a wrap?